Welcome to our Taking Stock video for the week ending the 26th of May 2023. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. Welcome, Jace. How are you today?
Very good. A little bit cold in Melbourne.
Yes, it's quite cold actually, but I hope you're keeping warm and hope everyone is keeping warm as well. But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts and tables presented shouldn't be relied upon as a guide for future performance. Well, Jace, currently the markets lack a clear direction as the debt ceiling negotiations in the US remain unresolved. And this, along with worse than expected UK inflation numbers, has heightened investor concerns. Consequently, though, bond traders are now ramping up their bets on interest rate hikes over the forthcoming two US Fed meetings.
That's right, Ken. And despite this turmoil, we've witnessed a resurgence in tech stocks within the growth universe over the recent weeks. This revival is primarily fueled by growing optimism around artificial intelligence utilization and robust operating performances from technology giants including Apple, Amazon, Microsoft, and Nvidia Corp. Given these stocks significant weights in the S&P 500, which collectively represents 20% of the index, it's unsurprising that the US market has been outpacing the Aussie market over the recent weeks. Our advanced charting tool on screen illustrates this trend. Without these tech stocks, the US market's recent performance would actually be negative.
Yes, Jace, those tech and growth stocks appear to be doing quite well, but turning our gaze to the Australian landscape, strong earnings updates have also come from our tech stocks as well. Borderline star growth stock, business analytics software provider, Technology One, and we'll talk about that more later on. But also we had logistics software designer, star growth stock, WiseTech as well. They did quite well in recent times. But we're also having a look at online accounting software business Xero, which could potentially emerge as a borderline star growth stock following its annual results release. If you're looking at Xero on Stock Doctor, you can see that the outlook suggests substantial growth in return on equity and free cash flow. And that's largely thanks to management changes, job cuts, and a restructuring plan.
Stock Doctor members who are interested in companies engaged in artificial intelligence can use our stock filter tool to identify these potential opportunities. Simply type in artificial intelligence under business description and include any additional fields of interest such as financial health and also return on equity. Be mindful that many of these stocks are financially unstable and unprofitable, so the risks associated with these businesses can be rather significant.
Yeah, there are quite a number of financially unhealthy companies there, Jace, but it's really important, financial health and assessing the active risks are paramount to the investment process. And for instance, within the technology space, many buy now, pay later companies are also financially unhealthy. And this week, the government has decided that the buy now, pay later sector will be regulated under credit laws to determine that products are suitable for their users under responsible lending obligations. Now, this regulatory change will restrict consumers' ability to purchase products, thus putting quite a bit of pressure on the earnings growth potential for these high-risk stocks.
And speaking of the pressure as well, Kien, it has driven negative market sentiment towards this retail space, and this has been also weighed down by inflationary pressures and also rising interest rates. Only this week, non-star stocks, City Chics and Universal Store Holdings released weaker than expected trading updates, which put significant pressure on their respective share prices.
Yeah, I'm glad we avoided them, Jace, but we really need to be mindful of investing in stocks in that retail space, especially given that many of them appear to be paying quite an attractive dividend yield and could potentially be yield traps as well. So, there's a lot of risk in this sector at the moment with higher interest rates and also slowing consumer spending. But remember, you've just got to select those businesses that have very strong brands, high profit margins, for instance, good inventory management and positive cash flows, and of course, a clear growth strategy to help these companies mitigate these risks. Now, when you were looking at our star stocks and the retailers here, you've got Super Retail Group, Wesfarmers, Lovisa, and Premier Investments, and they all appear to fit this quality criteria.
That's right, Kien. Now, back onto the risks topic that you noted on just previously. We did remove Treasury Wines Group as a borderline star stock after management came out with softer than expected earnings guidance for FY23. Members who want to read a little bit more about our decision can read our analyst commentary. But in a nutshell, inflationary pressures on product packaging and also softer demand for lower priced wines in the US resulted in the earnings downgrade. While the potential lifting of Chinese wine tariffs remains an upside risk, we want to see evidence of a business turnaround before we gain a little more comfort in the story.
Yes, Jace, quite a disappointing outcome for this stock, but it's also important for us to understand that, not all stocks in your portfolio can be winners. And from a risk management perspective, it's quite important to be objective and really cut your losses early when heightened risks emerge. Remember, don't rely on hope because hope can lead to further losses down the track.
And onto the corporate calendar, it's going to be a quiet week on the star stock front, although we will be keeping a close eye on any star stock retailers that may provide a trading update.
This week in Under the Microscope, we're focusing on business analytics software provider Technology One. The company recently released its first half results, which by most accounts lined up with consensus expectations. But to start off with, Jace, let's just delve a bit deeper into the company's operations and the services they offer.
It's a good question, Kien. Technology One specializes in developing and distributing financial management and accounting software. Roughly 76% of the company's revenues comes from the government and education sectors, and a whopping 98% of total revenue is reoccurring. This predictability provides us with higher earnings visibility around its forecast figures, especially with 11 analysts covering the stock.
The forecast certainly looks more credible than, say, some of those resources, Jason. And I've observed that the company's customer retention rate is quite impressive as well at around 99%. And such factors ensure that the company is able to provide a stable revenue profile. Now, Technology One's return on equity is also quite remarkable, standing at 43%, which is higher than most of its competitors. And what's unique about this figure is that the company doesn't have much debt at all, and typically companies can artificially boost their return on equity ratio by leveraging their balance sheet. But this isn't the case with Technology One. And apart from the operating efficiencies, growth has also been driven by them winning new contracts with around 20 significant deals over the past 2022 financial year.
That's right, Kien. And the company has been one of the few that have successfully transitioned its software towards a software as a service or SaaS model without sacrificing earnings growth. This means its software has moved towards a cloud-based service to allow end users to access the software anywhere with an internet connection. Moreover, the company's careful cost management helps it maintain a high net profit margin of around 24%.
Yeah, those metrics are very high, Jason. And I do note that the company's share price is currently trading at quite a high PE multiple as well, at over 50 times, which seems high, but when we're considering the high earnings growth profile and retention rates, it's not surprising to see these quality stocks trade at such high valuation multiples. But in fact, when you're looking at the current share price at approximately $16 per share, that aligns pretty closely with the fair value of the median consensus price targets.
That's right, Ken. And for members wanting a comparable company to TNE, Objective Corp could be something of interest. Like TNE, Objective Corp also caters to the public and private sectors, and both firms operate on similar earnings metrics. However, a key difference is that Objective Corp does not capitalize any of its R&D costs, while TNE capitalizes around 50%. As such, OCL's or Objective Corp's earnings are a lot cleaner and easier to understand and may sometimes be understated in comparison to T&Es. Objective Corp is also trading at a cheaper valuation as well.
Yeah, so please refer to our commentary just to understand some of those risks. But some great points there, Jace. It's also good to see that the company founder, Adrian DeMarco, and his business partner, John McTaggart, they retain a significant skin in the game. Note that Adrian retired from the company in February 2022. Therefore, his holdings are difficult to see. However, Mr. McTaggart, he remains the largest shareholder at 12% of shares on issue. A topic we frequently discuss on Lincoln Live is skin in the game and the importance of having alignment between shareholders and management. So for the question of the week, we ask, how do you track and interpret changes to director holdings on Stock Doctor? Having management's interests along with shareholders encourages better capital allocation decisions and also can lead to share price outperformance.
That's right, Kien. Investors should look for companies where there is significant holding by a director or founder, and if there's a large sale, they should figure out why that transaction occurred. On Stock Doctor, you can access this information under Golden Rule 7. For example, you can see this with Alkane. The chairman, Ian Gandel, has reduced his holdings by 21%. Now, to investigate this further, you can click on the Corporate Details tab, where you can see all the transactions the directors has conducted and a summary of his holdings at the top.
Yes, in the case of Ian Gandel, he has been progressively selling down his shares since June 2022. This does raise a few yellow flags, but the company informed the market that this was due to new business ventures Mr. Gandel was forming. In our view, though, we don't like to see such significant sell downs, but having the disclosure and communication here is positive, and it does reduce some uncertainty here.
Yeah, open communication is very important. And in many circumstances, Ken, the change in ownership could be the result of options expiry or exercises. We do place less importance on these transactions, but they are good to follow in order to understand whether the director has met their incentive targets, which is more often linked to measures such as earnings growth. We can see that with drilling services provider DDH1 CEO Sin Van Dyke was issued shares in November 2022 for meeting certain performance metrics. But ultimately, we do not place a large importance of this because he did not actually buy shares on market.
Yes, Jace, it's quite important to realize this distinction. But for members who want a quick glance at recent management movements, they can also refer to our strategic commentary as well. As famous investor Peter Lynch said, directors could sell for any number of reasons, but they only buy for one. Therefore, we do love to see management buying stock on the market, which clearly indicates that they are positive on the future prospects of the business. That's all we have time for today. And thanks again, Jace, for joining me with your insights. Very valuable.
Fantastic. Thanks for having me again, Kien.
And if you have any questions with today's episode, remember, feel free to participate in our Lincoln Live webinar this Monday. And also, with the end of financial year approaching, it may be a good time to introduce Stock Doctor to your family and friends so that they can take advantage of the upcoming promotions. You can either do this by the Refer a Friend tab or send them a link to the free trial page. So, to summarize today's episode, be mindful of investing in those financially unhealthy stocks, especially those that have garnered strong media attention and have great stories. The buy now, pay later space springs to mind here. Focus on the fundamentals of the business. Are the companies generating strong profits and cash flows instead of relying on capital raisings to stay afloat? And finally, not all stocks in your portfolio can be winners. So risk management is important here. Remain diversified and cut your losses if active risks become too great. Thanks for joining us today, and we hope you have a happy, healthy, and prosperous week ahead.